Yes, hi there. Welcome to another session of Manifested Online classes. My name is Joseph Kimani. I want us we continue with topic number 4, and the topic is presentation of a financial statement. And in this session, I want us we look on how a statement of cash flows is prepared in accordance with the International Accounting Standard number 7. So to start with, we need to define what is a statement of cash flows. Now, a statement of cash flows is one of the components of the public financial statement, and it is prepared by a company to show the sources of cash and the application of the cash. So mean that a company prepare a statement of cash flow to show how it was able to generate cash, and also how that particular cash was utilized, or basically how the company spent that particular amount of cash. So therefore we can say here that a statement of cash flows, a statement of cash flows is prepared to show sources and application of cash. Sources and application of cash. A statement of cash flows is prepared to show sources of cash and application of cash. Basically what that means is that as a shareholder of the company, once you go through a statement of cash flow which was prepared by the company, you'll be in a position to know how the company generated cash, and also how that particular cash was utilized, or basically was spent by the company. Now, when this statement of cash flow is being prepared, then it should be prepared in accordance with the International Accounting Standard number 7. And basically that standard requires that in preparing the statement of cash flows, then the activities of the company should be classified into 3 categories. Which are those 3 categories? Operating activities, investing activities, and then financing activities. And once those activities have then been classified into 3, then what the entity should do, what the company should do, is to determine the net cash flows from each of those 3 activities. So therefore here we can say that in preparing the statement of cash flows, the activities of the company or of an entity are classified into 3. So in preparing or in presentation of a cash flow statement, the activities of a business entity are classified into 3 categories. So which are those 3 categories? Number 1, I've said we have operating activities. Number 2, we have investing activities. And 3, we have the financing activities. Activities. So therefore the activities are classified into 3. So what do you mean by operating activities? When talk about the operating activities, these are the activities undertaken by a company or by a business entity to do what? To generate revenue. A good example of such activities include provision of services. If the company provides services to its customers, that is an operating activity. Or another good example of the operating activities is the sale of goods. So the company may be selling its goods now to the customers in order to do what? To generate revenue. So therefore, operating activities are those particular activities undertaken by the company to do what? To generate revenue, to generate what? Income. On the other hand, when we talk about now the investing activities, these are those particular activities which are undertaken by all are those particular activities generally which involves acquisition and disposal of asset. Those particular activities which relate to acquiring or acquisition and disposal of assets. Disposal of assets. Acquiring and disposing what? Asset or selling what? Asset. Finally, financing activities are those particular activities which are undertaken by a business entity and which by the end of the day affect the size and composition of the company's capital what? Structure. So therefore, these are activities which affect the size and composition of a company's capital structure. Company's capital structure. And therefore, good examples of such activities, which by the end of the day will be affecting the size and the structure of the company's, that is activities which affect the size and composition of the company's capital structure include activities such as issuing shares, issuing debentures, acquiring bank loan, the repayment of bank loan, and so on. All those particular activities, by the end of the day, they will have to affect the company's capital what? Structure. And therefore, after classifying the activities into those three categories, then what we do in preparing the statement of cash flows, we then determine what we refer as the net cash flows from each of these three activities. How do we determine that net cash flows? We take the cash inflows. So basically, when we talk about cash inflows, we are talking of cash which is coming into the business. For instance, whenever the company sells or disposes asset, the company receives cash. The amount of money which is received in a business is a cash inflow, is money which is coming into the business. The rule is that when preparing the statement of cash flow, any amount which is a cash inflow, in our statement of cash flows, we record it as a positive. We record it as what? As a positive. So we take the cash inflows and then we less what? We less the cash outflows. The cash outflows is basically money which is going out of the business. Good examples of this is like when the company acquires an asset. Once the company acquires an asset, the company will have to pay for that. Equally, once maybe the company repay a bank loan, the company do what? For example, pay dividends. In all those particular cases, we have money which is flowing out of the business, which is now a cash outflow. Equally, the other rule is that when preparing the statement of cash flow, any amount which is a cash outflow, we record it as a negative. So we take cash inflows as positive, we less the cash outflows, and then what you get the net cash flows. So basically, we determine the net cash flows from operating, investing, and also what? The financing what? Activities. That is the requirement of what? The requirement of IAS 7. Now, on the other hand, when preparing this statement of cash flows, there are various methods which are used. We have something called the direct method and the indirect method, which may be used by an entity or by a company in terms of preparing the statement of cash flow. But before we look on the actual presentation, the actual preparation of the statement of cash flows, I want us to define some few terms, basically which you're going to come across in preparing our statement of cash flows. So we define some few terms. We look on definition of terms. Definition of terms. So these are basically some of the terms you need to know because we are going to come across these particular terms in preparing our statement of what? Our statement of cash flows. So which are those particular terms? The first term is cash. So in this case, when we talk about the cash here, we are talking of the cash in hand, cash at bank, including something called the demand deposit. So we can say that these include cash in hand, comma, cash at bank, and the demand deposits, demand deposit. So when talk about the demand deposit, we are talking of, for example, the cash which is held in a fixed deposit account, or even any cash which is held in a money market fund. Basically, we know that if you have money in your fixed deposit account, you are operating a fixed deposit account. For you to be able to access that amount of money, you have to notify your bank, and you can only be able to access that amount of money maybe within 2 or 3 working days. So such money held in a fixed deposit account or even in a money market fund, we refer to it as demand deposit. So the other term which we need to define here is something called the cash equivalent. Cash equivalent. Cash equivalent. So on the other hand, when we talk about now the cash equivalent here, the cash equivalent, this refers to the short-term investments which can be converted into known amount of cash within a short period of time. So these are what? These are short-term. These are short-term investments. Short-term investment which can be converted into known amount of cash, within a short period of time. Within a short period of what? Time. Now, what is a good example of such cash? What is a good example of short-term investment which can be converted? Converted into known amount of cash within a short period of time. A good example of this is investment in shares, which are trading in the securities exchange market. So once a company or even as an individual, you have invested in shares which are trading in the securities exchange market, and you need some cash urgently. What you just do is instruct your investment bank, instruct your stockbroker to go ahead and sell those shares. Within 1 week, you'll be having money in your account. So therefore, that is a cash equivalent. It's not cash here, but it's an equivalent of cash, because if you need cash within a short period of time, you'll be able to do that. So therefore, such a short-term investment which can be converted into known amount of cash, then we refer to them as what? Cash equivalent. So the other term is something called the non-cash items. Non-cash items. Non-cash items. So when talk about the non-cash items here, we are talking of items of incomes or expenses which do not involve cash inflows or cash what? Outflows. So these are items. These are items of incomes or expenses. Items of incomes or expenses. Which do not involve cash inflows or cash inflow or cash outflow or cash what? Outflow. So items of what? Items of incomes or expenses which do not involve cash inflows or cash what? Outflows. So what are good examples of such items? What are examples of these? Examples include depreciation. So we know that depreciation, we account for this as an expense, but depreciation do not involve any cash outflow. It's not something like rent or something like salary. We know salary is an expense, but by the end of the day, it involves cash outflow. Once the employees have been paid, then there is outflow of cash in a company. Another good example is what we refer as amortization of intangible assets. Amortization of intangible assets. So which is still the amount of intangible asset which has been written off. So this equivalent to depreciation is accounted for as an expense, but this does not involve any cash what? any cash outflow. Another good example is impairment loss on goodwill. So impairment loss on goodwill is the decrease in the value of goodwill. Equally, that is equivalent to depreciation, is accounted for as an expense, but does not involve any cash outflow. And also we have the gain or loss on disposal. The gain or loss on what? Disposal. All these are good examples of items of incomes or expenses which are taken into account in the computation of the profit for the year, but they do not involve any cash outflow or any cash what? Any cash inflow. So therefore, these are basically some of the terms which you need to know or which you must be in a position to define, because definitely you are going to come across these particular terms when preparing the statement of cash flow. So then from there, let's proceed and work on the presentation, how we prepare now our statement of cash flows. A presentation of a statement of cash flows. A presentation of a statement of what? Cash flows. So here when we talk about the presentation, basically we are talking of the preparation. How do we prepare, or how is a statement of cash flows prepared? Now in this case, I mentioned earlier on we have two methods which are used in preparing or in presenting the statement of cash flows. That is the direct and indirect what? Method. So therefore you can say that there are two methods. There are two methods for presenting a statement of cash flows, a statement of what? Of cash flows. Two methods of presenting a statement of cash flows. So which are those two methods? So the first method is known as the direct method. The direct method. And number two, we have the indirect. We have the indirect method. The indirect method. So let's start with the first method here, which is the direct method. Direct method. But even before you look on, or basically we discuss what is a direct method, it is first of all important for you to note or to recall what you have said there, that in preparing the statement of cash flows in accordance with IS 7, then you have to determine the net cash flow from operating activities, net cash flow from investing activities, and net cash flow from what? Financing activities. So the difference between these two methods, the difference between direct and indirect method, is how we determine the net cash flows from operating activities. How we determine the net cash flow from operating what? Activities. So meaning that under the two methods, in terms of how we determine the net cash flow from investing activities, net cash flow from financing activities, we do that using the same approach under the direct and indirect what? Method. The only difference between direct and indirect method is how we determine the CFO, the net cash flow from operating what? Activities. So therefore, under this method, that is under the direct method, how do we determine the net cash flow from operating activities? We can say under this method, net cash flows from operating activities, and actually we abbreviate this as CFO. We abbreviate this as CFO. CFO is what? Is net cash flows from operating what? Activities. Net cash flows from operating activities. So we determine the CFO directly from the cash book. Directly from the cash book. So you go to the cash book, and one, you take into account the cash which was received from debtors or customers, you less the cash paid to who? To the suppliers or creditors, and also you take into account the cash paid for operating expenses. So therefore, we can look on how we determine the what? The cash flows from operating activities. How do we determine the cash flows from operating activities? Using this method. Using this method, that is the direct method. That is the direct method. And you have to remember that this is the only difference, how we determine the cash flows from what? From operating activities. So to determine this one, we take into account the cash received from debtors stroke customers, customers, of which this cash received from debtors or customers, this is what? This is cash inflow. This is money which is coming into the business. You have to remember the rule here. When preparing a statement of cash flow, I've said any amount which is a cash inflow, any amount which is a cash inflow, we record it here as a positive. This is money which is coming into the business. We record it as a positive. Any cash which is or any amount which is a cash outflow, in our statement of cash flow, we record it as what? As a negative. That is something you need to recall and which is very, very important here. So cash received from debtors or customers, this is something you can get from the cash book on the debit side. When if you go to the cash book prepared on the debit side, you'll be able to get the total amount which was received from the debtors or who? Customers. Then we also take into account the cash paid to the suppliers, stroke creditors, So the cash paid to the suppliers stroke creditors, that is what? That is cash outflow. That is cash outflow. We record it here as a negative. We record it there as a negative. We also take into account from our cash book the cash paid for operating expenses. For operating what? Expenses. The cash paid for operating expenses. Still, this is a cash outflow. Is a cash outflow. And then we get the net amount down there. Net amount. And then out to this, we proceed and we less two items. Which are the two items do we deduct here? The tax paid. And actually, the reason why we less the tax paid is because once the company pay a tax, that is still cash outflow. That is still cash outflow. And then we less the interest, or the finance cost. The finance cost paid. Interest or finance cost paid. So interest or finance cost paid. And then what we get down there is now what we refer as the net cash flows from operating activities. Net cash flows from operating activities. From operating what? Activities. From operating activities. So that's how we determine what? That. Then from there, when preparing the statement of cash flows, you have to equally determine the net cash flows from investing and financing activities. So therefore, what we need to do here, before we look on the other method, that is the indirect method, let first of all we proceed and look on how we determine the net cash flows from financing activities and also investing activities. So next here we look on how we determine the cash flows from investing activities. What do we need to remember here? We need to remember that investing activities, these are those particular activities which basically involves acquiring and disposing what? Asset. That's what we need to remember. And therefore, what we take into account here is the disposal of assets, disposal or sale of assets. And when the company sells the asset, what we consider here is the sales proceeds. how much amount was received from selling assets. Not the cost, not the net book value, but the sales proceeds. We also take into account acquisition of assets. Acquisition of what? Asset. So these are basically assets which were acquired. And asset acquired, these involve cash outflow. These involve movement of cash out of the business. And basically, disposal of asset is a cash inflow. You have to remember our rule here. Any amount which is a cash inflow is a positive. Any amount which is a cash outflow is what? Is a negative. That's what you are doing here. This money received from selling asset is a cash inflow. This money paid in acquiring asset is a cash what? Outflow. And then what we also consider here is any investment income received. Any investment income. In some questions, you can be given this as interest received. Interest received is a form of an investment income. Investment income. Basically, we get the total amount. We take it to the last column. Remember here, we should have two columns. And then finally, we determine the cash flows from financing. From financing activities. Financing activities. Equally, remember what you have said, that financing activities, that is, these are those particular activities which affect the size and composition of the company's capital structure. In fact, all the items which we include here, or which we take into account here in preparing or basically in determining the net cash flow from financing activities, all of them we get them from equity and non-current liabilities section of the statement of financial what? Position. So what we consider here include things like issue of shares, shares which were issued for cash, So mean that here we exclude something like a bonus issue. We exclude a bonus what? Issue, because we know that once the company make a bonus issue, these are shares issued free of charge, or basically shares issued for free. The company do not receive any amount of money from such an issue. So we take into account shares issued for cash. We exclude any bonus issue. We also take into account any increase in share premium. The reason why share premium increases is because the shares were issued at a premium. We also take into account here the dividends paid. So dividends paid is a cash outflow. Remember, money received from issue of shares, money received in form of premium, all those are cash inflows. We also consider what? A bank loan acquired, or a bank loan repayment, So bank loan acquired is a cash inflow. Bank loan repayment is a cash what? Outflow. We also consider things like debentures, or even bonds, which were issued, which is a cash inflow, and also what we consider here is like any payment which was made at a finance lease. Any payment made at a finance lease, or basically at a lease. So if the company had leased some asset and the company paid some lease payment, we also consider that here. And then we get the net amount. We take it to the last what? A column. And then here what we do is we get something called the net changes. The net changes in cash and cash equivalents. Net changes in cash and cash equivalent. And basically we get that by adding three items, by adding the net cash flow from operating activities. This one, net cash flow from operating activities. The net cash flow from investing activities, and also from what? financing. So we add those three items, or those three figures. So wherever you get there, we refer to that as net changes in cash and cash what? Equivalent. And then now to this we add the cash. You have to recall we said that cash, these include cash in hand, cash at bank, any short-term what? Any demand deposit. So we take cash and cash what? Equivalent. So cash equivalent, we have said that these are short-term investment. Short-term investment, balance brought down. Balance brought down is at the start of the year. So you add all those items. Any cash in hand, any cash at bank, bank overdraft, and also short-term what? Investment at the start of the year. Add all of them, and basically that is known as cash and cash what? Equivalent. And then what you get here is known as the cash and cash equivalent balance carried down. Balance carried down, this is S at the end of what? Of the year. S at the end of the year. So basically that is it. That's how we determine the cash flows from net cash flow from operating activities, net cash flow from investing activities, net cash flow from what? Financing activities. Then next I want us to look on how do we determine the CFO, or the net cash flow from operating activities, using now the other method, the indirect method, because you have said the difference between these two methods, direct and indirect, is how we determine this, how we determine the net cash flow from what? Operating. How we determine the net cash flow from investing, the net cash flow from financing. Under the two methods, we use the same what? Approach. So therefore, I want us to look on how we determine the CFO, the net cash flow from operating activities, using now the second what? Method here, and that is the indirect method. Indirect method. So let's look on the indirect method. Indirect method number 2. Indirect method. And how do we determine now the CFO? How do we determine the net cash flows from operating activities using this particular method here? So what we do is that we take the operating profit, or basically the profit before interest and tax, and then we adjust that profit with three categories of what? Of items. So therefore you can say here, we can say here that under this method, the CFO, you have to remember that CFO is the net cash flow from operating activities. The CFO is determined by adjusting the operating profit, Operating profit, in other terms, we refer to this as a profit before interest and tax, PBIT, profit before interest and tax, with three categories of items. So we adjust that profit with three items. So which are those items? One is non-cash items. Non-cash items which were either added or deducted, in arriving at that profit. In arriving at that word, a profit. Good examples of such items include depreciation, include any amortization of intangible asset, the impairment loss, and so on. So in this case, we have an acronym which generally here there is an acronym which you can use to remember the items to be adjusted to your what? Or the non-cash items to be adjusted to your what? Profit. We use this acronym dial G. So D here stands for depreciation. Then I stand for impairment. Impairment loss. Impairment loss is a decrease in value of goodwill. A stand for amortization of intangible assets. Amortization of intangible what? assets, and then we have L, which stands for loss on disposal, and then we have G, which stands for gain on what? On disposal. So therefore, you can just remember that acronym, which is dial G. This particular acronym here will help you in terms of remembering some of the non-cash items which were added or deducted in arriving at your what? And your profit. So generally what you do in determining the net cash flow from operating activities, we adjust this particular profit here, profit before interest and tax, with these items. So any item which was deducted in arriving at this particular profit, e.g. depreciation, impairment, amortization, you add it back. Any item which was added in arriving at this particular profit, e.g. gain on disposal, you do what? You less it. You less it. So that is the first category of items we adjust in our what? Profit. Number two, we also adjust that particular profit with the investing and financing. Investing and financing activities items. Items added or deducted in arriving at that profit. Now here we have good examples of such, and that is investment income. Investment income. An investment income, this is an income generated by the company from investment. And what we know is that when preparing the income statement, any investment income, we account for it as part of other income. So meaning that in arriving at this particular profit, this particular investment will have been added, and because it is not an income from operating activities, what you do, you less it. You do what? You less it from that particular profit. And number three, we also adjust that profit with the changes in working capital. Changes in working capital. And in this case, when we talk about working capital basically is the difference between current asset and current what? Liability. So here we consider three items of working capital, and actually we also use this acronym RIP. RIP, this is the acronym which you can use to remember the items of working capital which you consider here. So R here stands for receivables. I stand for inventories, and then P here stand for what? For payables. So these are the items of working capital which you consider, and what you do here is that you have to determine, was there an increase or decrease as far as these three items are what? These three items of working capital are concerned. Once you determine the increase or the decrease, then you have to determine, is that increase or decrease a cash inflow or cash outflow? For instance, if the inventory increased, the reason why the inventory of the company increases is because more inventory was what? Was purchased. So therefore, an increase in the inventory is automatically cash outflow. And then, on the other hand, the inventory may have reduced. So the reason why inventory will reduce is because the company sold the inventory. Sold what? The inventory, which then is a cash inflow. So therefore, under the indirect method, and that's why we refer to this method as indirect method, we determine the CFO, the net cash flow from operating activities, using an indirect approach. We take the PBIT, adjust that with a number of items, three categories of what? Of items. So I think we can look on now the format of determining the CFO, the net cash flow from operating activities, using now the indirect what? The indirect method. Using the indirect method. So cash flows from operating activities. Using now the indirect method. Using indirect method. Remember, always I've said you should have two columns, and what we start with here is the profit before interest and tax. But in most of these particular questions for cash flows, the examiner will not have given you the profit before interest and tax. What you have been given is the profit before tax. So what we start with here is the profit before tax. There are some cases whereby you can be given loss before tax. So a company may have reported a loss, so you can be given loss before what? Before tax. So this is what you start with, or the profit before what? Tax. And then you adjust this profit with a number of items. You make a number of adjustment to this particular profit. And the first adjustment is always the finance cost, the finance cost or the interest. Remember what you have said here, we should always start with the profit before interest and tax. But I've said in most of the questions, you don't have been given that. So what you do, start with the profit before tax, and then the first adjustment here come and add back interest. So why are you adding back interest? You are adding interest such that you'll have now that your profit before interest and what? Tax. That's why, first of all, we add back the interest. And now we have the profit before interest and what? Tax. And then to that particular profit, you come and you adjust now these particular items. So maybe you can start with these non-cash items. I've said you can just use this particular acronym, dial G. So in which case, D here stands for depreciation on PPE. This is a non-cash item which was deducted in arriving at that profit, added back. I stand for impairment loss on goodwill. Still, it was deducted in arriving at that profit. You add it back. We have amortization of intangible assets. Still, it was deducted in arriving at that profit. What you do, you add it back. Loss on disposal. This is also an expense. In arriving at the profit, it was deducted, add it back. And then we have the gain on disposal. Gain on disposal. This was accounted for as an income in arriving at our profit. So what you do, you less it because it's a non-cash what? Item, a non-cash items. Also, there are other items you may capture, you may take into account here, something like amortization of government grant, amortization of a government what? A grant. This is the amount of government grant which was amortized during the current year, and such a government grant amortized during the current year is accounted for by the company as an income, but this is a non-cash item, so which was added in arriving at our profit up there. So equally what you do, you less it. So and then other items which we may capture here is investment income. Investment what? Income. Investment income was added in arriving at our profit there. And because this is not an income from operating activities, you less it there. You less it there. I think those are some of the items which you adjust now in your profit there. You get the net amount there, which we refer to as cash flows. Cash flows before changes in working capital. Before changes in working capital. Before changes in working capital. And then from there we proceed and we consider the changes in working capital. We consider the changes in working what? Changes in working capital. So here we have said changes in working capital, we consider 3 items here. You just need to remember that acronym, RIP. Here R stands for receivables. N stand for what? Not N, but rather I stand for inventories. P stand for what? For payables. So as far as these items are concerned, what you just need to do is to determine whether there was an increase or decrease during the current financial year. So an increase or decrease. So in this case, any increase in an item of current asset, like an increase in inventory, that is a cash outflow. That is a cash outflow. Any increase in item of current asset is a cash outflow, and basically decrease of the same is a cash inflow. The reverse is true when it comes to liability. So you just determine whether there was an increase or decrease, and then you determine whether that increase or decrease is a cash inflow or cash what? A cash outflow. And then adjust that to your figure up there. And then finally, we come and we less the tax paid, and also what? The interest on the finance cost which was paid. And then what you get here is the CFO. So CFO in full, this is the net cash flows, the net cash flows from operating activities. From operating what? Activities. From operating what? Activities. And automatically, once now you get that, you have to proceed and you determine what? The cash flows from investing activities, cash flow from what? Financing activities. But we have said in terms of how we determine those net cash flows from investing, financing, and the two methods, we use the same approach. So therefore, you can see the only difference between direct and indirect method is how we determine what? The CFO, the net cash flow from what? From operating what? Operating activities. Okay, so I want us to take a short break and then we come back. Before we look on an illustration question, there are some accounts. I want us we look on how they are prepared, because in preparing or in tackling any question for cash flow, you must be in a position to prepare a number of accounts, like the PP account, like the tax account, and so on. So we take a short break and then we come back and then we look on how do we prepare those accounts.